The power of coming to events like this or family office club summits is that like you could meet one person and then you could meet 100 investors through them. One of our members met somebody who was a CPA, and that CPA referred 43 investors to him. He was in the real estate space. Michael Scott, who spoke earlier about the AI tools, he runs a investor CEO founder network, a wealth velocity network. He's kind of growing that right now, and he came here, figured out how to raise $8 million after not having raised capital anymore, and then had a $100 million exit from his company. So exponential things can happen. It might take 2 events or 6 events or 16 events, but there are connections in the room with investor clubs, large multifamily offices, centimillionaires, et cetera. So I encourage you to check out or talk to Michael about the Wealth Velocity Network, or go to also another investor club we're associated with is Due Diligence Club. If you're here as an investor, duediligenceclub.com. So I thought that her talk about simple summaries was important. We talked about that a lot. Trust equals traction, as we talked about later today, and did earlier. Being authentic. Brian coming and speaking with his Western shirt and a sense of humor, that sets him apart from 95% of finance people right there, maybe 99%. Right? Both are almost never seen on stage, so that's amazing. And no fluff. So that's some of the notes I took. Earlier, she was talking about next gen, and I talked about the one pager that I read every morning, that I travel with, et cetera. But I also have a one pager for my kids. So I just wanted to show that real quick. What this is our family values at the top. And then I read the Arnold Be Useful book to them. And then we used AI to summarize the Arnold book. I also had them do a YouTube video with me kind of summarizing the book. And then Success Principles by Jack Canfield is 52 principles to live your life by to be a successful person. And that way I can tell my kids, you could ignore everything your teachers tell you, everything that people say on TV, you can ignore everything in the world. If you live by this one page, you're going to be ridiculously successful. It just kind of simplifies things. And so we have this at the breakfast table. We'll read a chapter from a book a little bit while they're getting ready for school, or go over one of these points. And it's really helpful. And that just makes it simple, passing on values, I think. All right, we're going to go over distribution now. So we had the founders of Barefoot Wines come and speak at our event. We did a fireside chat on stage with them. They basically found this distressed wine company, and they owed them a small debt. They were going to shut down the wine company, and they said, okay, well, we'll take the wine company. And they were able to grow that into the largest wine brand in the world, and it started in their laundry room. And then they had it taken over by private equity on their way up. And what they said on stage is that you need to think, who gets rich when I get rich? Who are my partners? Who should I do a joint venture with that would change everything? In just about every business, distribution is everything. Who has distribution on the shelf space at Costco? Who has distribution in terms of deal flow and get to see deals first? Who has distribution of capital access? Who gets access to information first, to the data centers that are limited in supply, to the energy to supply their data centers? Distribution is almost everything. And if you decide on a really amazing position, like we talked about in the last section on positioning, and you don't build up your distribution channels, you don't build up protection around it, you don't build up relationships, et cetera, then you're basically inviting anyone just to crawl into your sandbox with you. And it might be a great niche, but then 500 other people join you because there's no barriers to entry. What you really want is to have it look like this. So if somebody looks at your little niche, they say, well, maybe I should choose this other 7%, because those guys have that locked down, at least for San Francisco, or at least for the state of Texas, and just do something slightly different, or want to work with you. And then you let the drawbridge down, they come inside, and they make the walls even higher, because now you partnered with a blue chip, publicly traded company, or a centimillionaire that has access to things in Singapore, and you hadn't expanded there yet. So a strategic choke point is something I got from the book Mastering the Rockefeller Habits from Vern Harnish. And it is an asset that once you acquire it and obtain it, it usually makes it impossible or hard for anyone else to. So we talk about this a lot. If you've been in the club for 2 or 3 years, you've heard me talk about this quite a lot. Every time I think about this and work on it, it makes my company bigger and we make more money. And so it is something I would encourage you to put a lot of time into. It's brought us millions and millions of dollars and made our company secure and stable over 18 years. And so the mental investment into this, you will get a payoff, and I'll show you how to do that at the end of this section on distribution. And it's essentially, look at what is your friction point? What slows you and all your competitors down? Is it deal flow, investor flow, research, information, energy? Is it some sort of high cost or point of friction, some annoyance, something that's just the worst part of your business? Figure out, could you acquire a small business, start a business, develop a tool that would flip that on the head, and now you are the TSA and you also own the gift shop at the airport. No one likes it, but it got to go through you, right? And so figure out how to obtain those things and strategically build them. Some don't cost anything. It just takes being there first. Some takes positioning, naming. Some is just a domain name. Some is just writing a book. Some it's a collection of omnipresent resources on a little niche. Other times it might be moderately expensive, but then you find someone else that would benefit from owning that choke point with you, and you have them fund 90% of it because you thought about it, you're going to run it, and they see the instant value once you explain the strategic choke point, and you get 2 to 4 like-minded cooperators that other people consider competitors, and you take down that choke point together. We've done that many, many times, and the more we do this, the better we do. Almost everything I present today is partially me talking to myself, knowing if I keep doing this stuff, then good things will happen. And that's why we want to share these best practices. The better you do because of things you hear here in the club, the more you're going to want to be in the club for the next decade. So I win if you take something away and write it down on your page 17 today and take it away. So at the beginning of our business, we were able to grow our blog to getting 3,000, 5,000, 7,000 hits a day. I bought familyoffices.com. We made it the most visited website in the family office space. Wasn't a lot of competition back then on that, 2008. We then got a book deal with Wiley. We brought our networking group online to LinkedIn. We hit about 1 million members on LinkedIn, probably in 2012, 13, 14. We had 42 groups then. We have 84 groups now on LinkedIn for networking. And then we had more family offices speaking at our event compared to any others. These are all little choke points where once we had the book deal with Wiley, people spoke at my event easier. Once we had 1 million people on social media, now we got more deal flow, more investor flow, more connections, right? So one choke point gave us momentum, and it's like the flywheel that Jim Collins talks about, like a 5,000-pound piece of metal on a slight decline. It might be really hard to turn it over, but then after it starts rolling and has momentum, then it's hard to stop that flywheel. It can crash through a wall of bricks. Even if there's something to slow it down, it's just going to have a lot of momentum. So I would encourage you to try to think about your business in this way. Was there a choke point or big strategic move you made? I think this is so critical that every billionaire we interview, this is one of only 3 questions that we ask the billionaires. Of all the smartest questions I could possibly think of, I ask them about this. What was the turning point, one move you made, or a strategic choke point, which after you acquired it, everything went straight up? So you can check out billionaires.com to see 45 answers from billionaires on this topic. We're only talking about this for 3 or 4 minutes today. Happy to take questions, but we do have a 1-hour webinar just on this topic, and we do have an AI tool called Choke Point Coach. It's a newer AI tool for us, so you can give us feedback if it works or doesn't work super well for you, but it is functional right now and inside the portal. But those are 2 things you can do to go deeper on this topic of choke points. And also I'd encourage you to check out Vern Harnish's book, and the chapter on choke points is pure gold. So I'd encourage you to check that out. Any questions on this topic or on choke points?
Yeah, but Rich Hoffman.
Oh, you were? Oh, let me hold it up for everybody. I didn't realize you were reading it. This is what it looks like. And yes, he has a newer version called Scaling Up, which I don't like, so I don't recommend it. I mean, it's still a good book, but I think this one's even better. Thank you. Great. Okay, so this is different. This is distribution, but this is for deal flow. So this is especially helpful for any investors in the room, but also for anyone that is acquiring companies in your industry, or anyone that is building a real estate platform, private equity group, and you want to acquire assets. This is something that every $1 billion plus private equity firm does, and I've never met someone with under $1 billion AUM who does it, but it only costs about $7,000 a year to run this process and a little bit of your time. So I'd encourage you to do it, because the companies that big private equity firms want to acquire, when you manage $1 billion in assets, you can't mess around with someone doing $500,000 in EBITDA. Even a bolt-on is a waste of time unless it has at least 1 to 3 million EBITDA, and many times the bolt-ons are 3-5 million EBITDA for big private equity firms. So the great thing is this is a proven process. It costs almost nothing, and none of your competition is using it, because most people in here aren't running billions of dollars. If you are, then you probably use this process. Most firms have 2 to 7 people doing this. It is basically Like let's choose any niche, like manufacturing in Connecticut. So you do like machine stamping, manufacturing, aerospace type stuff. You could say, okay, we want to focus just on expanding in the Northeast area. Let's look at 4 different states and only machining manufacturing companies. Let's just find 100 leads that are in the exact same niche or very related niche to what we're already doing. And it's hard to see their revenue. You really can't. We're just looking at a manufacturing company's website. You could look up some big data on them with ZoomInfo or Apollo or something and take a guess, but I wouldn't mess around with that. It would just slow you down. Come up with the criteria for what those companies would look like, and then give them to your outsourced help through like Upwork.com or something, and hire someone for $6-12 an hour to build that database for you. Spot check it as they go to make sure it's accurate. Then you script a 1.5 line email, send it out to the CEO of each one saying, hey, I run a manufacturing company in your same niche. I'm just an 1.5 hour drive away, and I was looking to invest in or join the board of a couple of synergistic companies. Not sure if you'd be open to a strategic investment or a board member or an acquisition, but I'd love to chat and talk shop if you'd like to sometime. And just a sentence and a half cuts through all the stuff coming in their inbox, because people, when they get approached by private equity firms, they know that it's going to be a 180-page agreement with an army of 20 lawyers. And that agreement's going to be very one-sided. This is entrepreneur to entrepreneur. I do exactly what you do, and it works even better, of course, if you're able to say, I just sold my manufacturing company to private equity. It took me 18 years to do it. Now I'm sitting around and looking if I can invest in or join the board of a couple of companies in the same niche. Want to get coffee for 5 minutes? They know they're going to learn something by going to coffee with you, because you are who they want to be when they grow up. That's what gets you the meeting. No one else is emailing them with that offer. So if you write that email right, and you can use our the capital raising email analyzer AI tool to help you with that, then you get on the phone yourself. You can have your team send the email, but you're the one that handles the replies to the emails, and you get on the phone with everyone who wants to have a call or a meeting, of course. And then you identify those that make sense. So in one of these processes, we targeted 370 acquisition targets. I got on the phone with 70 of them. 8 were investable valuations. And we got a couple of transactions done from that. And we have people following up years and years later saying, oh, you guys still acquiring people in our industry? Because we're ready to sell now. No one wants to do this because this is reading the software manual that Mark Cuban talked about. It only costs like $7,000 to get the virtual assistants to help you. But going super thorough, super laser focused, if your family made your money in auto dealerships, so you have that expertise, but you also believe in the future of stem cells, well, then you could say, let's make a database of 150 auto dealerships, 150 stem cell companies that are already revenue positive, and then let's go after both sleeves. But even multi-billion-dollar single-family offices that I know rarely have more than 1, 2, or 3 verticals where they try to do it in-house and be world-class and go super deep and own that niche or sandbox. So I wouldn't go beyond 2 areas and go deep like this for deal flow. But any questions on this? I'm sure some of you do this already, but it's very rare to see. Is anyone in the room doing this like full on all the time? 1 person. Awesome. 1 or 2 people. So one theme of today is the most valuable ideas none of you are doing. No one wants to change their brand name. No one wants to do this process. No one wants to read 200 books authored by billionaires. But that's why it works. If everyone was doing it, it'd just be table stakes. It'd be like telling you need to get an email address and a website. Like, okay, well you do, but it's just table stakes. It's like the very, very basics. Yes?
A question. So another way is sort of inbound funnel, where let's say if you're positioned, on LinkedIn or wherever, saying that,
right.
I'm interested in this kind of deal.
Right. Yeah, exactly. Awesome point. So the last section was all about the positioning, and his comment was that basically if you're positioned well, saying like, I invest in dry cleaning chains, and you say dry cleaner investor, strategic dry cleaning shop investor, et cetera, then people will find you when they're looking for sources of capital, and that's amazing. But the best thing is if you say that and wear it on the sleeve, then when you email someone, your brand name, instead of saying Wilson Family Office and no one knows what type of deal flow to send you first, you call your family office Strategic Dry Cleaner Capital, and then people know what to send you. If I see a dry cleaning deal, I'm going to send it to you first because I don't know anyone else that's buying up dry cleaners, right? It's super deadly simple. It's not complex stuff, but no one does it. And we had someone at our last event as an NFL player. He's raised over $100 million. He's spoken at a couple of our events. And he is in the process of buying a soccer team in Italy that includes a private island because he was at our events. And then my friend is from Italy, mentioned that he's investing in a sports team. So I just mentioned it to Kyle, and now they have the team under contract to close on. So we'll see if they close or not. It's not a deal that I'm part of or marketing, but it's a good example of exactly what you're talking about. Is just a unique thing, and you connect it to the other unique point. But if you're not unique, then it just gets lost. No one sends it to you first if you're not unique. Any other questions on this process? Great. All right, so here's 4 different million-dollar questions you can ask yourself. Who in your city or industry has all of the client leads, capital, or deal flow that you need access to? Where if you could joint venture with them, partner with them, reward them for helping you, then you would have everything that you need. That is basically the choke point. Because if you can figure that out, and you take that position of being their best friend in the area of accounting, and now they refer all the accounting leads to you from their law firm, why would they refer them to anyone else unless you lost that position? Now it's harder to displace what you've built up. Number 2, how could you be thought of as first for something, targeting a very specific type of client? So we have a book called Centimillionaire Strategies. It's one of the only books written for centimillionaires, and it talks about the mental models and challenges they go through. So that's an example of a very unique position. Number 3, how could you make it inevitable that you would have massive distribution? Like if I partnered with the #1 food expo in New York that has 60,000 visitors a year, and I gave them equity in my food company, and I got a booth in the front row, and I had people join my board from that, you'd probably get deal flow. Or like if you're a strategic food capital is the name of your family office, that's where you made your money, and you want to get more deal flow, then buying part of the food expo in New York and buying 5% equity in them would get you a ton of deal flow. And everyone would want to be your friend because they think that you could get them exposure at the biggest food expo in the world, right? Number 4, what is a wholesale platform ecosystem way to dominate distribution? How do you create a whole platform, a community, an association, a club, some sort of relationship-based network, or tap into someone who does to get things done? So the reason I put it as these types of questions is that in Keith Cunningham's book, The Road Less Stupid, he's built a couple $100 million plus businesses. He gives some real centimillionaire quality advice that I would guess that nobody in this room does. He says that you should sit in a quiet room, ask yourself one of these questions, and just sit there for an hour, the pen and paper, no phone, nobody there to interrupt you, lock the door, and turn off notifications, and then just come up with 20 answers to one of these questions. And it's the reason why Oxford says that brain rot is the name of the word of the year last year, because with everything going on and so many Slacks and WhatsApps and text messages and emails and phone calls and everything else going on, calendar invites, masterminds going on, it's hard to sit, focus, and just focus on one thing strategically for even 15 minutes. It can be really powerful. How many people do that for even 15 minutes, one time in a whole month, focus on one question in pure silence and just go really deep on that? Sam Altman last week said that it should be a rare thing when a high-power CEO takes action, because a lot of his energy should be going, or her energy should be going into strategy, figuring out the right path forward, figuring out the right position, figuring out how to scale, and then you take action. So I think that's really powerful to think about. And so if the world is going to, there's more pings and there's more data information overload, and there's more requests on your time every single day. I only got 800 emails a day 5 months ago. Now I get over 1,050 emails per day is what my email meter stats say. So every day, more stuff coming at all of us. And if you're more successful, you have more employees, more K1s, more LLCs, more requests, right? Better quality opportunities than last year coming at you. So it's tempting to get busier and busier and busier, but then slowing way down to a complete stop to focus on what is super strategic is part of why you're here today. But I also encourage you to be unique in that way, because nobody does this. This is not natural. And that's the benefit of it. Any questions on this or distribution? Yes.
What does your environment look like when you do that? Do you go somewhere also that
Yeah, good question. What does my environment look like? So when I'm shaving in the morning, I read that one pager and I try to think what I want to have happen today, like who I want to be in the world and what's like the number one thing. Every week for 14 years now on Mondays, I do a catch-up call with my friend Jason, and we say what our one focus is for the week, so that helps. And then I use exercise sometimes for this, because I do have a hard time doing it. So I'll go on a run and be like, while I'm on that run, I'll listen to music, but then have like one thought in my mind. And then there's a little mini summit, like 1,000-foot summit next to my house on this like cement military bunker overlooking Lanikai. And I'll go up there sometimes and I'll bring like my frozen cherries or mango up there, and I'll just chill up there for 15 minutes and either just relax or think about one of these questions. But the airplane's a great place to do it because no one can interrupt you. And yesterday, I tried to walk to dinner without checking my phone at all and then focus on my dinner, the whole dinner, not looking at my phone, put on airplane mode, and just plan out our investor superintelligence program that we're coming out with next week. And on the way there, I couldn't do it. There was something I had to check. I was like, I couldn't resist doing it. But during the whole dinner, I successfully did. And then it was helpful, right? So I'm not the master of the universe of this, but I feel like if I could get better at it, then really good things would happen. Because intuitively, I find it productive every time I do it. Anyone else? Any questions? No? All right, cool. Hopefully a few of you found that helpful. So today we've talked about AI, we've talked about mental models are really fueling everything, and we're really just transferring mental models from Brian, from Connie, from myself, et cetera, over to you. And like, these are mental models that work for us. And it's like a food buffet. You don't have to eat everything. Just pick and choose what looks good to you right now. Otherwise you get indigestion of all the ideas coming over. But this is an area that I think everybody could get sharper on. Every single person in the room could get sharper on this. It is overlooked by the wealthiest people I know. Most centimillionaires have no idea how to structure deals unless they made their money in M&A and investment banking. And so it doesn't mean just because they're ultra wealthy that they're masters of the financial universe. It just meant that they spent 30 years scaling up their merchant processing company and they're masters of that universe, right? And so you want to know how to add value to an investor, and it doesn't have anything to do with pitching them your deal. It is helping them structure transactions better, showing them like, hey, well, maybe next time you do a deal like that, which maybe it's not even in your industry, you might want to consider asking this or consider this structure, and just providing helpful suggestions on the fly is what shows them that you have expertise to share and that you're generous, et cetera. So this is the Deal Structure Ninja AI tool that you definitely should check out. I think it's one of our top 5 AI tools in terms of just practicality. Because every time you go to negotiate a deal, there is always a way to structure it better, to be more tax efficient, to preserve equity, maybe the investor is capped at 3x because they're passive and you're doing all the hard work. So you get to capture more of the upside, but they get de-risked first. Maybe you offer the investor capital, and for that, they're okay with a lower valuation because now they can sleep at night, et cetera. So there's just so many ways to skin the cat, and it's so overlooked, but it's so high leverage. So I ran this investor club for a decade before I started learning a lot about investor clubs. That's how long it took me. So I'm trying to emphasize it so you don't run your platform for another decade if you're not already deep down the rabbit hole on this. We have about 2.5 hours of content on our portal. If you look for a deal structure due diligence workshop within the portal membership, then you'll see a couple hours of content on this topic. And then I like this area so much that if you ever need to and you're looking at doing a deal, you really should send it to AI because they'll have a smarter answer than me. But if you ever want to bounce something off me, shoot me an email and say, hey, this is what I'm considering. If you see deals structured like this, or is there some other strategy I'd recommend? And I'm not an attorney. I know some great attorneys. So it's just kind of, in my experience, you might want to go down this path and ask your attorney to help you structure something like this, and that. And happy to be helpful in those ways. Okay. All right, so what I encourage is to have a strong, rigid, very crystal clear position, but not a rigid deal structure. There's some groups out there that just bang the start a fund drum so hard, they act like it's the solution to everything and it's the holy grail. A lot of investors want direct deals and not a fund, or a lot of investors won't go into a fund unless they know the person really, really well and don't like that they're blind to the deals in there. So if you're gonna do a fund, and some do amazing with them, I would also offer direct investments or co-investment rights for the fund investors. Or I'd let people invest in 1, 2, or 3 different direct investments before they're gated, and they either have to come into your fund or not. After 3 deals, they either like you and trust you, or they don't, I would guess, right? That won't work with everybody. But even the largest private equity firms on planet Earth, like Blackstone types, offer co-investments and direct investments because they know that that's what's needed. And they have the most leverage in the world. They're the most credible private equity firms in the world, and they know they raise more capital if they offer direct and co-investments. So keep that in mind. You're dealing with entrepreneurs, and if you walk into a room saying, do you want to be an LP in this fund? Here's the terms, take it or leave it. It's not going to go so well versus getting to know them, seeing how they normally structure deals, and saying, well, this is our normal LP structure, but you're strategic. If you could take a quarter of this deal or fund the whole deal, we'll make it worth your while because you're making our life simple. Now we have 2 people on our cap table instead of 19. That'd be amazing. So we'll give you a much better valuation if you want to make our life easier, and we'll add in collateral that would cover half of the risk. So very worst case, if we go completely out of business, I'm losing all the money I invested and you're only taking a half haircut, et cetera. So I'd consider that. I would consider having multiple share classes. That's probably the number one thing, is to figure out how do you design a custom structure with your attorney again, but you might have to come to with some ideas or her with some ideas, and that rewards your biggest investors or someone taking the whole deal. Super important. And the reason it doesn't happen a lot of times is you go to the average attorney and you go to them and they're dealing with a Rolodex of clients, and you say, well, I want to get this deal done. How should I approach this? And if you don't know how to structure something, whether it's a direct investment or a deal, they're probably going to say, oh, well, the best practice is to do it like this. Would you like to do that? And like, oh, yeah, that sounds good. Best practice. Follow the herd. And it makes the lawyer's life easier because he's using some templates and he'll customize it and hopefully listen to you carefully and customize it well. But it's basically built off some templates, and it probably makes his life way easier to use those templates instead of sitting down and saying, here's what I'd like to do. How do we maximize this while not doing this and considering these 3 other things? What would be some custom structures you'd recommend? If it's a really good attorney, they'll offer you a couple options, but many times they would much rather you just do it the best practice way. But then when you show it to an investor, it's going to look like everything else they look at, and it's not going to sweat for you. If your position is sweating for you, you get better deal flow, better follow-up, better acquisitions done. Even as an investor, your position gets you strategic deals. The number one most profitable thing that an investor can take note of today, I think, is that if you get to see deals first exclusively or at a better valuation, you're probably going to do amazingly well. Like Connie and her group probably get to see some deals pretty early on or first and at a better valuation perhaps because of the Kretsu network could add value, right? If Michael looks at a deal in the cannabis area or in like home services like Grey Tsunami area, and he can point to what he's done in the past, then and word gets around on that, then he's going to be able to see deals first exclusively and at a better valuation, and that changes everything. And if you're raising capital and you show to an investor night and day how your positioning, your distribution, your choke points, and your track record show that you clearly get deals that no one else gets to see, they're going to lean forward and say, oh, well, you mind showing me the top 0.1% of what you see? Or maybe even show me your throwaways because you're just doing Texas and we're actually open to Arizona too, or something of that nature, right? So I hope that makes sense. And great structure doesn't mean cheap fees. It's just maybe the investor wants a lot of their initial capital de-risked before you get paid super handsomely. And I think a lot of wealthy investors don't mind paying high fees, but they don't want to pay the price of a Rolls Royce and get a Honda Civic with no air conditioning. They wouldn't be wealthy if they weren't savvy. So they want to make sure, like, you've got some money on the line, that you're super motivated, people are aligned, etc. So we've used gross revenue royalties to structure many deals, probably 16, 17 deals now. We've done deals where we've acquired a third of a company, and then we get like 8% gross revenue royalty. It's usually much lower than that. Usually we're getting 1, 2, 3% gross revenue royalties, and it can change. So you could get royalty until you double your money. You could get a royalty until you get 1.2 times your money, and then exit equity warrant. So when they sell one day, you get a piece of that sale potentially. And if it's an exit equity warrant that can't get diluted, then you're getting that percentage when they sell one day, whether they raise more money or not. And it prevents you from getting diluted 19 times if you're not going to be putting in more and more money. So we love using gross revenue royalties. And each time we do one, we get it a little bit sharper along the way. So I'd encourage you to explore those over time. We also like, when structuring a deal, to say, if I didn't make my money in the med spa space and we're looking to invest into a med spa, what would be both the easiest way to raise capital and the best way to complete thorough due diligence? I'll go to someone who runs 5 very profitable med spas, show him what I'm doing or her what I'm doing, and ask for some feedback. And they'll naturally want to be part of it if it looks amazing, and then design a structure where they come in and take 20% or half the deal on some better terms and agree to doing a weekly or monthly phone call with the CEO. And it de-risks the deal, it helps the due diligence go faster, and then everyone else wants to invest after I have 2 med spa experts investing who took over half the deal, then everything else gets done pretty quickly, right? So that's really a shortcut. And one of my mentors, Sajjan Thomas, says that every time he raises $180, $300 million for one of his private equity clients, he's raised about $3 billion, he always goes for the anchor investor first that everyone else would respect. And after they come in, everything else goes quickly. And Blackstone, founded by Steve Schwarzman, his book was one of the top 10 books I listed, and it's printed out there in front of you inside that workbook. He said that he couldn't raise money from anybody for 9 months. And then he got a Japanese oligarch to come in, and then 2 more Japanese oligarchs, and then the money poured in, and they raised $1 billion very quickly after the first strategic investor. So if you're rigid, you might never get the rocket off the ground. But if you can do a creative deal structure, you could. I've had many, many deals where people told me to go away. Literally, their exact words were, "We're never going to do a deal with you. Do not ever contact us again." Because I followed up with them for 12 years, poking them every 3 months to buy their asset. And then I said, well, what if we structure it like this? And then they agreed to the deal, and we got it done. They said, if you can do that in 5 weeks, we'll do it. And then we did it in 5 weeks, and now we own billionaires.com because I was persistent for 12 years. I shouldn't own it. Goldman Sachs or UBS or RSM or someone big should own it, right? We're a tiny little small fry company. So keeping after things and being creative, in the investment world, a no sometimes just means no under that structure right now, in the mood I'm in now, at that price, at this valuation, and this economy. Things change. It might be yes next week or the next morning or that same day under a different structure. You can take a bad deal and make it pretty good with the right structure, and I can take an amazing deal and make it so I get all the collateral, all the cash flow, all the returns, and you're capped at a 1x return and make it horrible. The structure is everything. People go around thinking, if I put high returns on my paper, I'm going to raise a lot of money. It's the best deal you've ever seen. And that doesn't really matter too much at all. It's all the context, trust, team, conviction, process, being authentic, keeping things simple, and having the right structure so that it stands out night and day from the other 1,000 things coming at them. And people want a good return on their money, of course, but without all those other things, they don't care at all what you put on your piece of paper. Totally irrelevant. Any questions about any of that? I went through a lot of different ideas quickly. Yes?
Structure.
Structure.
An investor looks at it, right, or rather their legal team looks at it. If it's a highly customized structure, which is way different to everything else, does that actually shut them down because they're like, this is way too hard to evaluate compared to everything else I see?
Yeah. So the question was like, if it's a really creative structure, does it shut them down because it's so different than everything else? I've had a percentage of people say like, oh, I'm not really sure how to deal with that, and we have to explain it, and I've had it go well. I've had a few people where when it's creative, they say, no, I just want a plain vanilla deal. I don't want the mental gymnastics of trying to figure that out, and they don't want to be tricked, et cetera. I know when Michael spoke at our last mastermind, he said he went to a business owner of a martial arts center because he owned some of those, and he showed them the terms, and it was a simple agreement. And he took it to the attorney, and the attorney is like, oh, well, this is a little bit different than a normal agreement. I want to do this and add this and add this. And Michael sat down and was like, hey, look, it's either going to go well or not. Like, either trust me or not, it's going to go well. Whatever the paper says, it's really about us trusting each other and doing this. And the agreement captures the spirit of that. So if you want to, we can both spend a whole bunch of legal fees and make it super robust and, super, super thorough. But if you're okay with keeping it simple, like I'm going to do it, say I'm going to do, and let me show you, come over to my martial arts center and I'll show you who I am as a person, So always when you do anything, when you do plain vanilla, you're going to lose some people because you're plain vanilla. You do creative. So the trick is not to lose too many people, right? But the deal structure Ninja app will help explain each component of the deal if you want it to, and you can ask it for longer explanations to help de-risk that, because that is a problem sometimes. And some attorneys just won't want to work with you. They'll be like, no, this is like too out there. You should just use the standard formula. But you have to question their motivations. Do they make extra money if that deal goes well for you and you make more money 5 years from now? Do they make extra money on their legal fees if you raise the capital in half the time? No. Maybe they earn a referral if they're super helpful. But sometimes they're not the most aligned counterparties, I find. Yeah. Yes, in the back.
It was in that same vein. You pretty much answered it.
Okay, great. Any other questions about the last couple slides or royalties?
No.
Okay. For this raise, we thought of one family that would be strategic, sent them the offering, and it was a creative gross revenue royalty deal, and it had a little bit of collateral, and the first investor took it, and then the deal was done, like in 3 minutes. So it's interesting because it's an example of structuring a deal in a creative way that someone accepted right away as soon as they saw it. But also it's an example of why did that family get to see the deal and nobody else got to see it? It's like, well, I knew they'd be good, nice people to work with. I knew what they wanted. It fit what their needs were, and they had communicated what their needs were. And I had met with them in person recently, and so they were kind of top of mind. So they got to see the deal first, and other investors didn't even know the deal existed. And a lot of the best deals close with 99.99% of investors never even know it existed. And the most amazing deals you can ever do are deals like at the extreme. None of us are Oprah Winfrey, but if you're Oprah Winfrey or Warren, then you get deals on ridiculous terms because Weight Watchers wants Oprah's face representing them and her media empire and all that. But on a very small basis, to make it less lofty, like the comment earlier today, if you have built and then you sold your 2 gas stations for $12 million, and then you meet someone who's looking to build a ground-up gas station or has 1 location and they want to get an investment to grow to 2 or 3, they want you to be on their cap table. They're not talking to Oprah or Warren, right? Like you're probably the only person they know that's built a couple gas stations and sold it, that's given them the time of day. So you need to look for where you are in your path and then look for those earlier on the path, because that's where you have this super deep expertise for better due diligence, more high conviction investments, opening doors, getting distribution, negotiating with suppliers, negotiating leases, avoiding all the expensive mistakes you've made. So when we talk to an investor club that's doing a couple $100,000 in revenue, we say, hey, we could help you scale. Why don't you come speak at our investor club, or let's just be investor club friends and share insights and speak at each other's events, et cetera. And for some of them, they're just starting. We are where they want to be in 18 years. So we're able to get deal flow and access that we wouldn't be able to get otherwise. So I'm doing the same thing in my business. If there's any other questions, let me know. So with Dan Sullivan, I got mentored from him, and one reason why I went in there is that he had so much helpful information on his niche that he was a preeminent expert to get advice from on scaling a business as a founder. And I'd already profited from his ideas, so I was fine paying $50,000 a year to get mentored by him because I already made way more than that off his ideas. So of course I would, right? So if you reverse that flow when it comes to deal flow, getting meetings with people, and you're helping them and you're transferring your ideas and expertise to them as an investor, as a CEO, as a founder, or helping people in their family or referring clients to them. Now it's like they at least owe you a meeting. They at least owe you a little bit of an audience or keeping you in mind because you're like one of the more helpful people that they know. And having that, I always say that I believe in karma. And so, putting out more and more good karma, it just comes around long term. It's good business. So structure trumps strategy. You can recycle cash, or does cash go out to investors, right? Is there alignment? Who wins first, or does everybody win together? Do I get diluted, or is there anti-dilution rights? Can I invest more money, or am I not allowed to invest again? Like the idea of being able to invest another $1 million in the next 3 years that Brian mentioned, that's awesome. Stuff like that. I think some of the smartest families I know with deal structures, they have creative terms that nobody else I've ever heard of is doing. And it's like a go-to mental model. And every time they do a deal, they put in a little mechanic that makes it smarter than the past deal that they did. So I'd love for you to get to that point as well, because it can make a huge difference in how fast you raise capital, how much money you lose on the worst deals, how much sleep you lose at night, et cetera. Sam Zell, in his book, Am I Being Too Subtle, said that he was trying to buy up a block, and they had spent hundreds of millions of dollars buying the block, and there was one little single-family residential home from the 1960s there that would not sell, and his team says, we give up. We're just going to have to build around it and have a silly little home on the block in the middle of our apartment complex, and it's going to create a nightmare for zoning and permits and everything. He said, well, let me go out there. So he pulls up on his Harley and his T-shirt, goes in, has a cup of tea with his 84-year-old, and it turns out she's lived there forever, and her dog is buried in the backyard, and she didn't want to move. So he said, hey, how about this? You go on vacation, move all your stuff, we'll exhume your dog, rebury it in the new house that we'll pay for, and make it all painless and respect the dog in the whole process, and then she sold. So he actually took time to listen. It wasn't about offering more and more money, right? So that's really important. With one asset, we were going to buy it, and they said they'd sell it for $3 million. We're like, well, we don't want to pay $3 million. Why would you value it that highly? Just like Brian said, a lot of times people value things ridiculous amounts, right? And they said, oh, well, we strategically think this part is super valuable to us, so we wouldn't want to sell that. We said, okay, well, we don't care at all about that part. So you keep that part, and we'll pay you $450,000, and then we can get a deal done. And they said, okay, we'll do that deal. And then 6 weeks later, we bought the asset from them. So when people have a ridiculous valuation, you have to ask why. And sometimes you just structure around that, and then you get the deal done. But if you don't know how to custom structure things, you say, oh, okay, expensive, move on, and then the deal doesn't get done. So super, super helpful for those reasons. All right. Fee alignment, we've talked about quite a bit already, along with deal examples. In one deal, we put in a couple $100,000, and then we thought, who would take this deal? Because it's a little bit of a weird niche in the medical industry. And we thought of one person who's a centimillionaire who had at one time mentioned that they've invested in that niche. We went to him and said, hey, look, we put this money in already. If you'll risk almost twice that amount of money in the same deal, we'll make it so that you get all your money out first, then we get our money out, and then we share in the profits. So if we take a haircut and the deal gets cut in half, now I'm bald and he barely got a haircut at all. So I take all the brunt pain up front because I'm the one running the idea. If it turns out to be a dumb idea, it's 100% my fault that it was dumb. It was my idea that I came and pitched to him. And so that was the way we got the deal done. And again, went to one investor, got it done, papered and closed pretty quickly in a month. So on small to medium-sized deals, that's easier than if you're raising 50 million. But we've also had billionaires from our investor club put $30 million checks into things, 5 million, 8 million, 10 million, $30 million checks into things. So it doesn't have to always be a small size deal, but obviously it makes it easier if it is. Any questions on that, on the whole deal structure section? Yes.
Aside from structure, how do you know when an investor is stringing you along, right? I had that experience recently.
How do you know an investor is stringing you along? Yeah. No, it's a good question because sometimes, like one investor we've closed 19 transactions with, he's the most profitable investor to work with. It took us 6 years of getting to know him before we closed a single deal together, and then we closed 19 deals. So someone might have said the whole 6 years, man, this guy is stringing us along, but he's our biggest investor ever. The smaller the check, the smaller the investor, the less long the process typically, right? No one's going to meet with you 20 times to get you to invest $1,000 in a crowdfunding campaign. They might send you 20 emails, but they'll probably never want to meet with you to raise $1,000. So the bigger the check, the more patience you need, I think. And the more that it's a little bit out of place that they would give you 20 million, the more patient you would need to be, right? Like let's say you're raising 20 million and you're a startup and you don't have the track record yet, you have no revenue yet. It's a big ask. So it might take more patience and follow up. So there's a Harvard Business Review article that said, you can look it up, it's called, Should I Trust My Gut? They said, well, it depends what your gut's made out of. So if you've been doing it long enough to be like one time Michael and I were on a call with someone, and this guy talked a really big game, like way too big of a game. And in the first 10 minutes, I was like, I just don't like this guy, like at all. And I try really hard to always be really polite to people. So I apologized to Michael after the phone call because he set it up. And it only happens like once a year or something where I just fail to come off as polite. But I was just like, I just can't, I just don't see us working together. Like the way you talk and the way you beat your chest so hard that you're king of the whole world. And he was just saying things that just couldn't be true. And I was like, I just don't see like a lot of alignment here. So sometimes you just have to call it and you can smell it early on. And the faster you clip those off, the better. Like Dan Sullivan says that there's two types of pain. There's short-term pain and there's long-term pain. And you get to choose. For that employee, the joint venture partner, the bad deal, it's just going to continue to lose money. It's like you just got to cut that stuff off and get it out. So that'd be my advice, to listen to your gut more and more. If you've been doing something for a decade, I think you've probably all learned that more and more you regret not listening to your gut more often than the opposite. So, yes.
About gut, the most valuable thing I heard all week was a lady in LA who said she trains her gut every day. Right. So what I found was my gut was actually mistrained. So she actually said, okay, train your gut to actually get the outcomes you want. Train your gut to get the outputs you want. Interesting. Yeah. I mean, the reason why the one pager works that I held up earlier, I think is like one, it just makes it hard to forget what your priorities are basically. But the reason why it really works is because then you're basically putting this in your front temporal lobe and your prefrontal cortex and saying like, look for this in the world. And then you go out in the world and then you pattern match. And like Kevin spoke at our mastermind Q1, I think it was, and he said that all of business is pattern matching. You 10x what's working, you kill off what doesn't work after trying to fix it once or twice. And it's a lot easier to pattern match if you're learning from high quality sources and really know what you should be doing next. So it's kind of related to training your gut. We're going to break for lunch in just a second, but any other questions before we do? Don't forget to write a couple notes on page 17 on your worksheet. We're going to be calling on people later today, and that's how you get an ROI out of being here today, is actually taking actions, using the tools, using the ideas from today, figuring out unique positions, figuring out how to
answer those $1 million distribution questions, figuring out how you're going to upgrade your mental models from, billionaires, pro athletes, people that are further down the path from you, getting way more high quality deal flow with that private equity deal flow process, et cetera. So we've got 3 guest speakers after lunch. One's going to be a fireside chat. I've got another 2 sections to go after lunch. And one of the sections is one of the best investments of your time because it's how to protect your time. And the more time you put into protecting your time, then probably you're going to get an ROI on that. So hope you don't miss that after lunch. So Jimmy, for lunch, are they just serving it around the corner next door? Okay, so just next door there. We're going to start back at 1 p.m. prompt. So just a 33-minute lunch break, and then we'll come back here. Hope you're enjoying the event so far. Thank you.